there's many ways to trade, or many ways to trade successfully. And I see this in the comment section a lot, and I don't have a position, so I'd like to hear your thoughts, where there's this idea of a broken clock, where if you have a broken clock that's stuck at 6 o'clock, it's correct twice a day, 6 a.m., 6 p.m. So a lot of strategies work sometimes is maybe a position. Another thing is, well, everything works. And I see this a lot. Everything works. It just depends how you do it. Or the psychology component becomes the determining factor. But, trend line trading works and head and shoulder works and all these strategies work. Otherwise, it wouldn't be a strategy. Is the truth somewhere in the middle?
Probably. My own bias towards the whole thing is based on a lot of historical simulations. I can't even tell you how many simulations I've done in my lifetime, and how many 10, 20, 30-year studies I've done on price databases with huge amounts of data behind them. And I would say this, that any particular math, because I don't view an indicator as anything other than a sort of a mathematical filter to a bunch of price data, which includes information and noise. So I look at all price movement as either information or noise. My job as a trader is to filter out the noise and try to keep as much of the information as possible. So the way I like to think of a good example, a simple example that everybody could look at their broker platform and realize, is a Donchin channel. And I met Richard Donchin back in that's how old I am. I met him before he passed away back in the, I think it was the 80s, maybe, early 90s at the latest. And at a Commodity Corp Christmas party, actually. And nice guy, but he did a brilliant thing. He said, well, let's look back 20 days, whatever, and let's take the highest high of the last 20 days and the lowest low, and everything in between those 2 points is noise.
What's your opinion on that?
I like it. It's so elegantly simple. And it adjusts itself for volatility, if you think about it, because if prices, if I could use this without hitting the mic here, if the highest high and the lowest low over the last 20, 21 days, 15 days, 9 days, whatever you want to pick, if it's here and volatility increases, then it's here. So noise keeps going low volatility, high volatility, low volatility, high volatility. And when you then exceed the top side, you're definitely out of the noise and into an uptrend. And when you exceed the bottom side, you're definitely out of the noise and in a downtrend.
Would this philosophy apply in a range-bound scenario?
In a range-bound scenario, it would, hopefully, you wouldn't get a whole lot of trades. You would just be bouncing around inside the noise.
The reason I'm curious on this one, where you kind of average out the high and low and you get an average price, this is what a EMA, I guess, would be to an extent, a moving average. But then you would miss a lot of the beauty of what's inside, where, let's say, out of this range, majority of the time was down here. This could be a piece of information, or how it moved from the highs to the lows, very aggressively or very slowly. You'd be missing out on these details.
Well, in the All-Weather Trader, I talked about a lot of strategies that you could use to try to capture the noise. So the shorter term you go, you're inside the noise. The more you sell premium and options, the more you're using the noise to your advantage. The more you do mean reversion strategies, that would tend to be inside the noise, the more that's going to help you. So you can marry those. You don't have to trade one strategy. I trade multiple strategies. I have long-term, short-term. I have, upside strategies, downside strategies, sideways strategies. And I think if you marry them all together, my bias is that if you look at all the studies I've done, all the data I've looked at, all the different indicators and strategies that I've tried to simulate over the years, every strategy, you probably, if you examine the math, will find that there'll be certain periods that are going to be very, very favorable to that type of logic. And there's going to be certain periods that are going to be, you're going to be swimming upstream. It's going to be tough. And there's others that it'll probably do okay. It's not going to be good or bad. It just kind of hold its own. Knowing and marrying together different strategies, knowing how they're going to be in good shape or swimming upstream, and marrying a strategy that tries to make money when the first strategy is going to tend to lose money is going to stabilize your overall portfolio. And that's all I've done over the years. That's why I call it an all-weather trader, the name of the book. I've pretty much been trying to do that for a lot of years now, just try to keep looking at where are my drawdowns, what causes those, what types of market action am I not exploiting that I could exploit somehow using a different math that I can marry together as one more strategy in my portfolio so that I can just keep stabilizing the results and yet not give up my upside